Good morning, afternoon, and evening, ladies and gentlemen. Thank you all for taking the time to join our webinar today. I'm Cam, your host for today's webcast on our third installment for the year before we wrap up and head into 2026. There's quite a lot to unpack here on our agenda for today's webcast session here. But before we dive in, just going to go through a few brief housekeeping rules, go over the format really quickly, and a few compliance disclaimers afterwards. So this meeting is being recorded and a copy will be made available on our YouTube channel afterwards, in addition to a copy of the slides with some of the material that we probably might not have time to cover in today's session. The presentation will be approximately 30 to 40 minutes with a dedicated Q&A session towards the end. So please be sure to post your questions as we go along. And if they're pertinent to the topic at hand, we'll pick them as we go through the session. Otherwise, we'll save them towards that dedicated Q&A session there before we before we wrap up with our key takeaways and changes to the portfolio strategies. Now, before we get started, I do have to read out a few disclaimers here for compliance purposes, so please just bear with me here. Dunhill Financial is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale and/or purchase of any specific securities, investments, or investment strategies. Investments may involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategies discussed herein. Now, with that out of the way, let's jump in with some of the agenda that we have here. And I think the one thing that's on everybody's mind as we're racing towards the end of the year here is some end of year planning tips here. So, Alex, why don't you walk our audience here through some of the things that they should be paying attention to as we're getting towards the end of the year when it comes to their finances?
Okay, well, thank you, Cam. So as we come to the end of the year, we start thinking about next year, obviously, but we need to think about where we are now first. So at the end of the year, I like to advise people to review where they are. What does your cash flow look like? Your income, your expenses. Has it changed dramatically over the year? Do you expect it to change dramatically over the next year? It's a good time to review your balance sheet and have a look at all of your assets, make any updates that may be needed there as well. Then you move on to looking at the assets themselves. You have a look at the performance, the allocations within accounts, the risk profile. Make sure that all of those things are where you expect them to be. And if not, it's a good time to reach out to your financial professional to discuss any changes that may need to be made there. You also should have a look at your liabilities and have a look at all of the terms of those liabilities. It's a good time of the year to think about maybe if something needs to be restructured for the following year. There is also a need to look at your current insurance policies. If you've had any changes during the year, like a new baby, it might be time to look at whether your coverage is sufficient for whatever your needs are now and going forward. It's also a very good time to review your estate plan. So this can include your wills, powers of attorneys, trusts that you might have. Make sure that everything is up to date. And if there are changes that are needed, consult with a legal professional to make sure that those changes are enshrined the way you wish them to be. You should also have a look at your tax filing status. So this could be whether you're married filing jointly or married filing separately. And if you're an expat, it could include looking at whether you're taking the foreign earned income exclusion or whether you're taking the foreign tax credits. Those are very important things to know, so it's a good time to review that. In terms of your retirement accounts and your insurance policies, it's also a really good time to look at who your beneficiaries are and make sure those are updated and current. Once you've done those things, it's time to think about any money transfers that need to occur. So funding accounts for the benefit of others, such as 529 plans for children. It's a good time to get that done towards the end of the year. Making sure you've made contributions to your retirement accounts, if you so choose to do so. Making gifts as well, either to individuals or to charities. And you may use the qualified charitable distributions if you're already taking distributions out of your IRA. That's something to consider. You should also consider whether you want to convert any assets from your traditional IRA into a Roth IRA for the year. As well, if you have IRAs and you are at the stage where you need to start taking required minimum distributions, you should be thinking about taking that distribution before year end. You should also make sure you've completed any tax loss harvesting you might want to do. So if you have a lot of gains that you've realized in the year, you might think about selling some assets that are at a loss so that you can offset that. And finally, it's a good idea to meet with your financial planner to make sure that you've made necessary updates to your financial plan and that you've discussed any changes for the next year so those can be incorporated into your plan.
That's huge, Alex. A couple of those will identify as use it or lose it, i.e. IRA contributions, distributions from IRAs for those that might need to take those contributions towards gifting. If you don't make the gift this year, you lose that entitlement for the next year. Also for any charities, those are use it or lose it if you don't make that gift. And the tax harvesting. So those are those 5 really, really important. The others are housekeeping to make sure that you're actually re-reviewing things, and things are changing in the view of how certain countries are actually examining and viewing wills and trusts. So it's always a good time to review that on an annual basis. Thank you, Alex.
Welcome. And so the next piece here is we always suggest that it's a good practice to check your credit score once a year. So you can do this. This is a free service that you can do through the 3 major credit reporting agencies, Equifax, Experian, and TransUnion. But if you are an expat, please note you cannot use a foreign address for the request, but you can use your most recent U.S. address to verify your identity. It's really important to do this to make sure that if there is any identity theft, it gets caught very quickly. So it's a good practice to make sure you do this once a year. Okay. So the next piece is we have had quite a few changes over the last year, legislative changes. And as you all know, the Big Beautiful Bill Act was signed in July of this last year, July 4th, as a matter of fact. And as a result, we have changes that really span quite a few areas. I'm not going to try to hit on everything. It would take hours for us to go through every single provision of the bill, but broadly speaking, the Big Beautiful Bill Act extended provisions of the Tax Cuts and Job Act and kept in place previous cuts to corporate and individual tax rates that were passed in 2017. There were also Medicaid taxes, which were cut from 6% to 3.5%. That may sound good on one level, but it also means it's reducing funding for the program. Eligibility requirements were tightened, particularly the work requirement. And as a result, 12 million Americans stand to lose their healthcare coverage. There's been a temporary increase in the standard deduction for people 65 and over, as well as a tax deduction for older Americans earning under $75,000. There have been increases, there's been increases to the deduction limit for state and local taxes as well, the so-called SALT deductions. And this has helped to fund increases to defense and border spending of 150 billion US. For expats, however, the big news is the excise tax on remittances, which is section 70604, if you'd like to go look at the actual verbiage. It applies to transfers from the U.S. to a foreign destination after December 31st of this year. Tax is going to be at 1% of the amount remitted. So when you're sending funds to another country, they're going to add a 1% tax to that. And there were earlier proposals to exempt U.S. citizens or allow a tax credit, but those earlier proposals have been scrapped.
The majority of what we're reading is the interpretation that if it comes from a U.S. bank, we should be fine. But the problem is there isn't the clarity in the bill, and they haven't come back to that. This is why, essentially, if you're going to have a large expense in the first week of January, you might want to get the funds out of the United States before the first week of January, i.e., be prepared for them not being prepared because it doesn't clearly explain what these institutions need to be to not be privy to that 1% amount. So forgive our paranoia. That's what Alex and I do best, being paranoid. I was actually really happy to see that there wasn't huge changes on the inheritance tax. That could have really scared off people that are nervous about the deficit ever having a chance of getting repaid. If we would do away with inheritance tax in America, essentially, we'd have to increase taxes on everything else to deal with our deficit. So at least sticking it just a little bit of an increase to 13.99 million. Is that what next year's threshold is? So just shy of 14 million means the majority of us don't have to worry about inheritance tax, but the deficit doesn't have to find other ways of taxing people to be able to pay that down.
Excellent. Well, thank you very much for those takeaways there on the planning and tax aspects there in the US. Sticking with the same theme, we'll stay on the US trajectory there, and we'll unpack, I think, what's probably been the driving conversation, especially in the last couple of months, if not throughout the year, which has been tariffs. So I think ever since the April Liberation Day or Obliteration Day, depending on which side of the fence you were sitting on, there's been a lot of changes back and forth and a lot of headlines that have crossed, the different publications there. So, Josh, if I could have you unpack what's the latest update there when it comes to tariffs, and what are some of the things that our clients should be focused on or that we should be paying attention to?
Yeah, absolutely. First of all, so Brian and I are right next to each other, so I hope that you can hear me well, and for whatever I say, we'll blame Brian because his is the box lighting up. So tariff update. Now this is I'm sure we're all aware of just how the whole tariff aspect has been unfolding in the States, and well, earlier in the year it was kind of a discussion around, well, we had them put on, there might have been a temporary stay, there was a 90-day window. Well, we're well into the year, we're actually near the end of now, believe it or not. And well, the tariffs seem to be here for the foreseeable future, and there's additional ones very recently, especially with regards to pharmaceuticals. Now, obviously, this is not the only sector being targeted by these. Just to kind of back up for a second, for us to recall our Econ 101 courses. So what tariffs effectively are a tax on imports. Now, there's a mixture of, say, short run effects, market responses, and long-term structural things to consider in that, well, companies are having to deal and struggle with aspects of how do I make sure I get the right inventory? Do I want to consider having something in the US or maybe offshoring some more things? In the short run, there's been shocks across the board on that. Now, what does that mean for the economy and therefore you? Well, on the one hand, it being an import tax, what it basically means is that in this case, it's in a way, I would say it's in line with what Trump and his administration are trying to accomplish with having lower interest rates and an overall weaker dollar to boost exports because, well, you add to the inflation pressures with higher import costs in that type of way. That's part of why everybody on the call has probably seen where the dollar's been going. And we expect that to continue, especially at a time when, well, the Fed in the States has dropped interest rates and they plan to continue to do so for the foreseeable future. So I don't feel like I need to go through every single bullet point on there. I'm sure we can all read. It's just to say that if we're expecting this to continue for the foreseeable future, well, this is why we do want to have things like, well, for example, holding the longer term bonds in the portfolio because interest rates are going in this particular direction. And because, well, despite what might be working their way through the courts in the US, we do expect these tariffs and this overall strategy to be continuing and therefore constraining growth and household spending in these types of ways.
Mhm.
Now, if you go to the next slide, I think we have a pretty good kind of overlay. I think that's pretty useful, right? Going back to what just the average tariff rate has been historically. Now, as it relates to things like, say, the budget, for example, which I guess we'll get to also in a second, the common argument with the tariffs is that, well, they're going to be applying them such that it reduces the deficits in the government, which in a short run way, that's their argument that it might work. However, it is unlikely per what we have been reading and what we've been seeing in the market to be a replacement for broad tax revenue. And that's especially since it creates basically distortions in trade. So what will continue to compound over time is, well, companies that would normally trade just completely, maybe not completely, but relatively frictionless cross-border, now no longer have the means to do that. So it's going to keep feeding these kinds of distortions in the market over time. And again, to relate that to ourselves, probably having more of a constraining effect on household spending, for example, just people having to pay more money for the same amount of goods or inferior goods, depending on what we're talking, basically.
Mm. I think what's really interesting there, Josh, actually, just to unpack the chart a little bit for our audience, is the sheer rate increase that we've
It's
seen.
pretty drastic, yeah.
Right. I mean, this chart goes all the way back to 1900. I mean, how they source that data from
Yeah, that's not
JP
2000
Morgan.
folks. Yeah, just to be clear, that's 1900. Yeah.
That's 1900. So effectively, we're looking at tariff rates that we haven't seen since the 1930s, 40s, or the early 1900s, right? So these are sort of Depression era trade barriers that we're seeing come up in effect. And really, I guess one can make the argument that this is sort of a reverse of the globalization trend and continuing on the reshoring aspect there. What are your thoughts there, either Brian or Josh?
Well, it is part of this overall effect where we haven't seen tariff levels of this kind. And I know how this is going to sound before I say it. This is not me calling another Great Depression. It's just, it's about that era of, people have probably heard the term Smoot-Hawley thrown around before. This idea that, well, we don't necessarily need to have trade on that kind of basis. It can be more, well, focusing just more on our own internal policies. Well, if you're a company who's looking to think about, for example, hiring foreign workers, and it's therefore we relate that to the H-1B conversation. You have to kind of factor that in. And for now, it could be the case that they're thinking, well, it might be better to just have a US office, et cetera. But if you think about it, long term, this might just be driving companies to be thinking in terms of having something outside the US as well, just because, well, if we're going to be putting up barriers, as big as the US economy is, it's still fed by a lot of these foreign workers as well. So it kind of multifaceted in how we unpack that. But I would say that short run, there's some shocks, but I think the real kind of difference over the long term is how these companies deal with it by looking at other places where they might not have the same kinds of distortions that I mentioned.
We also have a large potential impact on inflation. This is something that we still haven't seen actually play out into the system. A lot of it is because with the anticipation of tariffs, inventory flows on PMI have actually been completely distorted. So companies will front run purchasing and stocking a lot of goods before the tariffs go into place. Now that the tariffs are there, okay, they have a little bit extra wiggle room based on what they have in inventory, but things will normalize over the course of time. It's not a prediction of inflation, it's a fear that it could impact inflation, supply driven instead of demand driven. And if we get inflation in the overall marketplace, after a few years of heavier than expected inflation, can become a perplexing problem. It can actually enhance over the course of time, and that will keep interest rates higher for longer, which forces the markets, the overall markets, a little bit softer.
Mm.
So overall, it's not something that I would be excited about because there's a lot of unknowns in here in a globalized world.
Right. And speaking of the inflation picture, we'll have more on that later. But keeping track of time, let's keep with the political theme there and jump on to the next item, which is midterms. So, what's going on there, Josh? What are some of the things that we should be paying attention to, and how does that potentially have an interplay with the wider markets?
Before you even talk about that building, isn't that building closed?
You got a padlock on the front? Is that what you're saying?
Yeah, well, yeah. I mean,
Yeah.
I thought all of us could walk into it anytime we wanted to, but right now it just happens to be closed.
Yeah, not a great day for walking tours, I'll be honest.
Before we get to the hope of midterm elections, can we talk a little bit about we're day 7 right now?
Yeah.
Of a lockdown.
Right.
So
so basically, for those unaware, which may very well be no one, so we're in the middle of like a shutdown of the U.S. government right now. Now I say middle, we don't know how long it'll go on, but point is, well,
you say middle because we're in 7 days, and the average average of the last 7 have been 13 days long.
Right.
So we're just over the peak.
Yeah.
If we can be average.
Yeah. What's historically happened is there's a shutdown after about 2 weeks. This gets resolved, and there's back pay, and not that there's not effects, but that's why up to now that's generally the way things have gone. Now you might be asking, why are we even having the shutdown? What gives? Especially when it's coming at a time when this is about passing of the budget, etc. And
What Trump said is the Democrats.
Yeah, but when your party controls the House, the Senate, and the White House, it kind of raises some eyebrows as to how well that argument holds.
How many votes do you need in Congress and the Senate to pass the budget?
Yeah, so we're going to need about 218 is the point.
And how many are there overall?
Yeah, indeed. Well, right now,
is it 236?
Yeah.
Sorry, 436?
Yeah, 435.
So it's literally 50% plus 1.
Yeah.
You need half the House and half the Senate
So
to
in
approve
other
this.
words, where are we getting this idea then? That
So the Republicans just need to actually have all Republican backing, and then the budget's passed. So
which means
it's not a Democratic problem.
And so
therefore, there can only be 2 scenarios that could actually play out in this whole focus. One of them is that the Republican Party is not as tight-knit as they like to make it seem.
There's dissension in that way for some folks. Yeah.
Or the second viewpoint could be that essentially this is their goal, is to shut down the government, keep Doge going, and keep shrinking the size of the overall government. Which one are we cheering for, Josh? As economists, as the stock market, which way would we like this to play out?
Yeah. Well, I mean, I guess it kind of gets into the question of what does it look like as a short run versus long run shutdown, right? Now, naturally, if we look at how it's historically played out, now it doesn't actually last that long. However, the longer it goes on, the more of a drag we tend to see on GDP. We were talking about this earlier. Usually it's with every passing week there's a shutdown. It's like what, 0.13% of loss on GDP. So in other words, okay, 1 week, 2 weeks, maybe that's survivable politically, but it won't really take that long. You think about just how much money that is for households to start feeling the strain. You think about people who aren't in work, who are furloughed, but they still have to come to work, perhaps. Well, if we're starting to see people think like we talked about also air traffic controllers, people who we kind of need to do their job every day, if suddenly they're calling in sick or they're just outright walking out, at some point is going to have an impact on the overall economy. And also the fact that the longer we get into it, the more burden there is on the household spend. That's only likely to accelerate this whole idea of we're entering some kind of downturn when the economy is really going to start to slow from this.
Am I the only one that's hearing or getting the PTSD from them calling out there'll be further delays to your flight today? So between 7 and 900,000 of the 2 million employees are right now furloughed.
Right.
163 million people in the United States are employed. So essentially a 0.5% of the US is right now. Sorry, let's define furlough. Furlough
Right.
means laid off in anticipation to be potentially rehired.
Potentially. Yes.
Potentially.
Right.
So they're not getting paid. They don't know if they will get that back pay. And we've had some of these that have gone on for 35 days in the last 20 years.
Yeah, give or take.
Something like that.
Yeah.
So you have 0.5% of the US population right now not knowing if they're going to continue to get paid or if they're going to be able to get a paycheck to pay their mortgage or anything else. And that then goes down.
Well, it's
the
not even
cycle.
just a spending issue. It's just the behavioral aspects of that too.
Absolutely.
Are you going to be making major purchases when you're in that scenario? Okay, 1 or 2 weeks may be relatively insignificant, but again, the longer this goes on, the more we're going to start to see how this unravels in the economy. And yeah, so it's very much a function of just how long this goes on and what the overall strategy is and what they're trying to achieve.
And we know their strategy earlier in the year was cut a lot of different departments.
Right.
And this is a fast and easy way for them to cut different departments. Now, the good news of if they're doing that slows down GDP, slows down the US economy, which essentially means interest rates should be pushed down
Right.
as unemployment goes up and GDP goes down, even if it's artificially put together. That is why we have some long-term bonds in our portfolio, and Cam will be talking about that later. But what could we be doing about this government in the nearer term?
Yeah, that's the other thing to think about. As you can see on the screen, we're about 391 days away until we have the midterm elections in the States.
So that's the 13th month?
Yeah, something like that. It's it almost feels right around the corner, considering just yeah. It seems like a lot's happened this year, but it's gone by pretty fast.
It's like having a baby. Days go by slow, but time goes by fast.
Yeah.
Something like that.
It sounds like very close to home for you.
Just right there.
So midterms, well, like I said, Republicans control the House, the Senate, the White House. Now, high level, the state of play is, well, currently, as of more than a year out, but so don't hold me to that. We don't have a crystal ball, but the House is currently leaning a bit by a couple percentage points towards the Democrats in the projections, but the Republicans are still very much competitive. Now, there are seats that are particularly visible, like Maine, Susan Collins is up for re-election there as well. So there's different pieces to be considering in terms of, well, we might see the Democrats into the House. The Senate is less likely. There are vulnerabilities there. It's not really a lock that the GOP could hold on there. But that's where I'm referring to Susan Collins, just to be clear, that's in the Senate, not the House. Generally speaking, they could flip the House. The Democrats could. Now, the way that this would relate to the markets, for example, or the economy or us overall, the market tends to, historically speaking, perform best or react best with a divided government. Perhaps for the sentiment that there's just more than one party in power and therefore there's a check on it in those types of ways. So that could be a welcome sign for those looking for that sense of continued stability at this point. It's just if we can have the Democrats into the House, maybe that'll be a sign that the market would respond more positively to that kind of an arrangement. Now, aside from that,
now, all of those are really important because essentially next month we have 6 different elections. If you happen to be in one of those regions, 13 months we have the other. I've posted about this on LinkedIn. We put it in our newsletter. You all should be aware of it as American expats. The thing that scares me the most as an expat is HR 4851. This is a bill put into place by a congressman from Arizona that basically states, as American expats, if we don't have a residence back in America, that we would lose the opportunity to vote. That's petrifying because that would be one of the largest forms of gerrymandering that we could ever see. And that pretty much means that we're going to be stuck with taxation without representation. Luckily, we live in the land of tea, so we can just throw all that tea in the sea, but I don't think it will work. So pay attention to that bill. Make sure that you write your congressmen and senators stating, hey, if you want us to pay our fair share, at least give us the right to vote. We got that back in the 1970s from ACA, some lobbying from ACA and some other great organizations. Those organizations are doing great work for us to just retain our rights. But these elections are extremely important, not just from the political vantage point, but from the vantage point of us retaining the rights as American citizens that live abroad.
Perfect. Well, let's go off to the more international side here a little bit and look at some potential tax changes that are happening in other regions, particularly in Belgium. So what's going on there, Brian, if you don't mind unpacking for our audience here, and what are some of the impacts basically that clients should be aware of?
Well, Belgium is just the beginning of a domino effect of different shifts, especially here in Europe, on tax legislation. Last year, we talked a lot about the UK changes that Rachel Reeves brought into place. Now, Belgium, after a long period of time of the socialist government talking about bringing in capital gains taxes, they finally brought it into place. There is going to be a 10% tax on all capital gains in Belgium. Now, if you don't live in Belgium, this is still important. Make sure that you're aware of the double taxation agreement and how it applies on those effects, because even though in all past years you've owed all the capital gains tax in America and nothing in Belgium, now you'll owe 10% in Belgium and the remainder back in the States. So you'll be able to apply that credit in Belgium back to the United States. Most countries work that way. We have something like 36 different double taxation agreements that clearly state those types of things, but you want to make sure that you apply that because a lot of times the residency-based tax, the residency country is the first place that receives the tax, and America secondarily. So you don't want to get that backwards, i.e., have this conversation with your US tax accountant and your Belgian tax accountant. If you need somebody that understands both Belgium and the United States, let us know. We'd be happy to introduce you to some that very much understand the system, but these changes could affect your taxes in a big way. Won't cost you anything, it just could affect your taxes.
Excellent. Moving along here, just for the sake of time, I know we're a little bit behind it, so we'll briefly go into the next couple of slides here.
You're saying it like that was Josh and my fault.
Perhaps. But moving on to the next theme, we're going to be unpacking what's actually going on here from an economic vantage point and a market perspective. And really what we're trying to do here is help our audience and our clients try to sort of segment the forest from the trees here with the apt autumn analogy there.
You have the wrong cover slide. We should have had a boat at high tide, because all boats are rising on high tide right now. And that is exactly what's going on here. It doesn't matter if you have commodities, if you have bonds, if you have stocks, international stocks, everything is up.
That's a great segue. And one of the boats that's not being lifted with all these tides, Brian, is the US dollar. So
always proving me wrong, Cam. You're always proving me wrong.
Why don't we first unpack what's going on here in this chart for our audience, and then let's take a deeper discussion of what's going on in the dollar and why are we looking at foreign fixed income for some of our clients.
I love that. I love that aspect. On the left-hand side, you can pretty much break down what we've been talking about: long-term trends of dollar strength and then dollar weakness, i.e., they don't last short periods of time. And right now, we're definitely going in and just at that start of that dollar weakness, i.e., Cam hasn't even drawn a blue line on that beautiful chart that JP Morgan let us borrow for this presentation. So essentially, this could just be the beginning of that mix. And down on the bottom right, I think this is one of the most important things to acknowledge. The first part of this leg down has been based on the Trump administration changes in policies, i.e., it's been mostly sentiment driven. I would say, and Cam will say if he disagrees, that the second leg will most likely be based on interest rates. i.e., over to the right, you've got the differential of interest rates in the United States versus foreign developed countries. And right now, you get 1.5% extra yield in the United States than you would in most developed countries. If interest rates come down in America significantly, let's say because GDP drops significantly, unemployment goes up, and the likes, if that gets to parity, there will not be the need to have dollars for that enhanced yield as much, and that would bring down the dollar, that second leg, in large ways. I believe that will be that precursor, and that's why we are buying foreign fixed income for most all of our clients. You probably started to see some new pieces both in exchange traded funds, but also individual fixed income positions. But that's not our only position when it comes to fixed income. When we're owning US fixed income, we're going more long term.
And why are we going long term there, Brian, on the US side, actually?
I forgot I have to wait for the questions before I answer them.
Yes.
So right there, you circled it for me. You gave me the opportunity to have the answer just right on the screen. Whenever we have interest rates, if interest rates go down, the value of our bonds go up. And the further you are from the fulcrum, the further you are from the center, essentially, the further they have to move up or down. So if we're expecting interest rates to go down, owning longer term bonds, 30-year bonds, because Cam won't let me buy the 100-year Disney bonds, and Alex for some reason has something really against Disney. I don't get what it is. Sorry to out you on that, Alex. Essentially, these predictions from JP Morgan is that we could have some of the best performance from the longer term bonds. So if we're buying US bonds, we want the opportunity to get the best rate of return from those knockdowns in interest rates, and it has to outpace that next drop in the currency. So the next page, we're really looking at what do people think about the US dollar for the next year? We know what we think about it for the next 5 or 10 years, which is weakness. But Cam, what are all these names and numbers about?
That's an excellent point there, Brian. And as you pointed out, I think with the dollar cycle, we have those 10 to 15-year shifts, and they're very protracted, and they're very rarely ever in a straight line, right? Or straight line both to the upside and the downside. And what we're looking at here is basically the sterling USD and the euro USD forecast for the next 12 months from the various different investment banks out there. And one of the things that I think that stands out quite a bit compared to some of the longer term trajectories there, which as you astutely pointed out, is probably going to be driven, well, in the earlier part was driven by policy changes, and then in the latter half going forward will probably be driven by more fundamental aspects like those interest rate differentials that you were referring to. The next 12 months, however, the consensus from a lot of these investment banks or Wall Street banks is for not a whole lot of volatility, especially in these currency pairs, which is a little surprising given the backdrop of everything else being uncertainty. But what it does tell us, as you were pointing out there, Brian, is we've had, close to a 10% decline in the dollar. Naturally, that's been to the benefit of both the sterling and the euro. So from that perspective, as you were pointing out, having some long duration US dollar fixed income can be a very attractive proposition, especially if we do get those potential of close to a 1% rate cut. As the JP Morgan chart was highlighting, we could be looking at equity-like returns from our long-dated bonds there, if that scenario were to play out. But I'd like to get your thoughts.
We prefer things to go slow, but if they go fast, we could get great returns from that in short order, i.e. we're trying to have our cake and eat it too. But remember, just because currency markets are calm right now, once interest rates go down, we could have that next big movement. The expression is that there's normally a calm before the storm. So this could be our calm for that period of time. And that's why we're wanting to make sure that we're actually getting ourselves structured for what happens if we have 10 to 15 years of dollar weakness. The piece we have in dollars, we make sure that we're going to outpace that drop in interest, that drop in the currencies. Everything else we want outside of America.
Speaking of outside America, that's a great segue into our next slide here, which is when we do get those periods of dollar weakness, on the equity side, what are some of the places that are most attractive and where do we want to be positioned?
Outside of America.
Thanks, everybody.
Be here all week. Try the veal. Sorry, Cam. Tough crowd this week. So first of all, Cam, you really see that these things last good long periods. Strength of dollar, weakness of dollar. But you're essentially seeing ex-US outperforming every single time that we get dollar weakness. It's not just developed markets, but it's also emerging markets, which you'll come to on the next slide. And there's so many great reasons for this. The most predominant is that most countries still have their debt in US dollars. So every time that the dollar goes down in value, it devalues. We also have a surge on commodities. A lot of these emerging market countries are commodity rich, and all of a sudden, that surge in commodity prices and a devaluation of the dollar is helping them grow their economies and their stocks significantly. But the reason I like the most right now of the devaluation of the dollar and why we're making shifts into more emerging markets and early in the year, more developed markets ex-US is because we're getting cheaper valuations, a lower price to earnings ratio. Cam, we were digging into these numbers. I've got baby brain. So remind me what our forward PE for the S&P 500 is currently.
So the forward PE for the S&P 500 is sitting just above 22 right now.
And historically, we've normally been closer to 17.
Correct.
So essentially, if we were to retract back down to our averages, we could have a 20% loss in the S&P 500. Whereas emerging markets historically sit between 10 and 14.
Yep.
So we can actually get a portfolio that's a lot cheaper by going international, both in developed markets and emerging markets. So that if we get a retractment in the stock market, we don't have as far to potentially fall in that retractment. We're not predicting a fall. We're just saying the higher you are, the further you have to fall.
And I think that this chart here from the JP Morgan Asset Management team really showcases that quite well. So just to unpack it for our audience here, the sort of different bar charts represent the different regions. You've got your green line, which is representing the more longer term averages. And then you've got the blue sort of dots, depending on how it is on your screen, showcasing where we are right now. And I think one of the things that stands out, as you were pointing out there, Brian, is that the forward PEs on the US equity markets are well above those averages, longer term averages, versus the Europe, UK, emerging markets, etc. They're either at the averages or slightly trending below them. So there's real opportunity, but more importantly, like you said, in those pullback periods, I think it does provide a bit of a diversification in our clients' portfolios.
Now over to the right, Cam, you love your sales, right? You love your nice little discounts, etc. What's on sale right now?
That's an excellent question. I'm glad you brought that up, Brian. So whenever we look at valuations, we always want to look at sort of how expensive it is compared to the global predominant market, which at this point is the United States. But we also want to look at what sort of discounts we're getting if valuations were to trend back in line with the longer term averages compared to the US at least. So what we're looking at here on the right side of the chart is the discount of those various different markets compared to the US. So in orange, you'll notice if we look at the Chinese equity markets compared to the US, earlier this year, actually, they were trading at closer to a 60% discount. Naturally, that discount has closed a little bit now, and we're sitting sort of at a 40% discount. And then you've got the UK there as well, which is trailing a little bit behind China, but equally as much discounted as you can get. And then we've got Europe there in purple as well. What it's really showcasing here is that there is still real opportunities outside of the US, despite the phenomenal run-up that we've had in international equities in the last 10 months or so. If we look at longer term averages and that longer term devaluation of the dollar, knowing that it doesn't just last 10 months, it's protracted over a number of years, what that really showcases to us that there is still, growth out there in the international markets and emerging markets. But again, it's being selective with your exposure there, and making sure we get the right valuations.
So long story short, just because essentially America's expensive doesn't necessarily mean that America has to come down. It could be that the rest of the world grows to those higher limits. They're at discounted levels. That's what we've seen for the most of the year, and we've seen not only the prices increase but the earnings increase to match those. I think this quarter was one of those anomalies where we got the majority of analysts actually increasing their earnings projections on the quarter. We don't usually see that in between quarters. So it's not just prices are going up, it's earnings are going up at a magnificent level. So always good to buy a discount there.
Exactly. I think for the sake of time, and just to make sure we have enough for our Q&A segment, we've really touched upon the emerging market segment there that you mentioned earlier, Brian. So we'll just land the plane right here and sort of recap for our audience of what does this actually mean for some of our clients, and what does this mean for their portfolios, which ties in quite nicely to some of the changes we've made to the portfolios, which you may have seen in some of your quarterly meetings that we've been having with your advisors, or if you've been reading our monthly newsletters. But really, three key changes here is what we've made in the last couple of weeks. We've exited our healthcare position completely. Again, some of you here in the audience will probably recall why we entered into that in the first place. Again, the framework being attractive earnings growth at much lower valuations. The calculus has changed a little bit there in regards to the political aspect, but also the future of the industry there. So again, we've taken that opportunity to exit out of that position and introduce some of the emerging market exposure that Brian and I were just discussing a little earlier. Now, having that emerging market exposure just brings us back up to neutral weight, not an overweight. But again, it's just making sure that we're capitalizing on that weaker dollar story that continues to play out, but also the more attractive valuations across the horizon there outside the US. And last but not least, the international fixed income segment. I think, as Brian was mentioning there early on in this segment, with that potential for continued weakness in the dollar, making sure we have the safe part of our portfolio in the currency that we'll actually be spending it or needing the cash flow in will be, exceptionally important going forward. And that's what we're continuing to position in. With that said, before we jump into our Q&A segment, a few, I guess these are commercials, I guess.
I wouldn't call it a commercial. So over the course of the last 15 years, we've done tons of seminars, webinars, meetings, and the such. What we wanted to do was give everybody a nice little chronicle of our process and some of the different analogies that we've been using on all the different subject matters, from estate taxes, double taxation agreements, and all the things that you want to think about if you're moving abroad. I'm happy to say, in 3 different categories, our new book that launched last week is an Amazon bestseller. So we're very excited about that. Thank you for helping it achieve that status in its first week. But please do take a read, and I would love to hear your thoughts on the new book. We also wanted to talk about on the next page, DF Direct. Some of you are not clients already, and you should know we have 2 different solutions: our full financial planning business, and then our asset management robo-advisor, of which we basically make U.S. compliant portfolios for all Americans that live abroad with no minimums. And that's the important part. So for those of you that haven't gotten started, as you're going through Alex's checklist of 17 things to get done before year end, that big one is get started. Even if it's just a small dollar amount, $50 a month, $100 a month, the hardest thing is just to get started. This gives you the opportunity to get started. For those of you that are already clients of ours, if all of a sudden you're finding that you're not needing all the financial planning or estate planning that we're offering, no harm, no foul. You still get to join us on all these different webinars and different sessions. You'll still get all of our material. But you can actually decrease your fees by shifting over to the robo-advisor, i.e. there's no cost to actually shift from one program to the next. If a year from now you decide to move back to financial planning, you can. There's no restrictions to doing so. We just only want to charge you for the services that you need. So a little bit of a la carte service right there. So check it out. Ask us any questions that you have. If you do have any, you can drop them to myself at brian@dunhillfinancial.com or our info box at info@dunhillfinancial.com.
Perfect. Well, that leads us quite nicely onto our Q&A segment here. So we'll give the audience a couple of minutes here to post any questions that they have. And in the meantime, I have a question actually for either Brian or Josh, which is, if we are fearful of a slowdown in the economy, etc., where are some of the best places that clients could be looking to position defensively when it comes to equities? Is it continuing to stay on the international side, lightening up on the US equity exposure that they have, or is sort of a slowdown in the economy a little bit bifurcated from the real economy, i.e. the stock market and the economy aren't always in sync?
Well, I would baseline this question as have we been in a recession? Are we in a recession, or are we going into a recession? It doesn't really matter. Everybody knows that the economy is a little bit softer than it was a few years ago. And you could spend all day long determining exactly which parameters that's based upon. But the reality is that essentially unemployment's gone up, GDP's gone down that little bit, and the uncertainty does not make us feel wonderful from that vantage point. That being said, the last year, the growth of the general stock market has mostly come from AI and definitely the tech sector. So it's not that they're fully insulated from what's going on. There's just still enough money to fund them. We've seen big purchases out of NVIDIA over into OpenAI over essentially this round robin of funding. And as long as there's money in the air, everybody keeps on dancing. And that's what's going on in the stock market. That's why we're seeing a lot of growth. The reason why we don't mind taking a little bit off the table and not dancing all the way through the night is because 95% of those AI companies are not generating profit. They might be generating revenue, but not enough to generate profit. So we're not trying to pick all the winners and all the losers, etc. We're just trying to say, how do we build a portfolio that we can feel very comfortable with and take some of those profits off the table as we get them to get into, as we were speaking about earlier, Cam, some more of the lower PE stocks, i.e. if we can continue to bring our forward price to earnings ratio back down to essentially the upper teens instead of the lower 20s, we'll have less room to fall if they stop dancing on that tech side of the universe. Obviously, the utility companies and the consumer staples and the likes are going to be a little bit more insulated from a market slowdown than more leveraged or small cap companies. But essentially, that's where we're finding those overseas and in emerging markets in this declining dollar.
Excellent. I think we'll give our audience here a few more minutes just for questions before we wrap up.
I feel like that question, there was a different dimension that maybe when people ask this question, I feel like they're really talking about a different thing too. What's the one thing people like to flock to when markets are volatile?
Cash, but cash is trash.
So therefore,
Actually, that's a great segue on the cash is trash part there that you mentioned, which is, sometimes it can feel quite
Cam's
comforting
got a
just sitting in
slide for
cash.
everything.
I've got a slide for everything here.
this was not planned.
Could you imagine Cam in his childhood? He would have had index cards for everything. He'd be the guy walking in with a big old shoebox of index cards saying, I've got an index card for everything.
Getting back on track here, I think as you were pointing out there, it can seem quite comforting just sitting in cash, especially when the wider market is falling apart. But over the longer term, if we look at sort of studies of being in cash versus being in a diversified portfolio of about 60% equities and 40% bonds, there, what you tend to notice is over the longer term, stocks and bonds always outperform cash because you're at least keeping pace with inflation on some of those asset classes, whereas with inflation with cash, you are losing a lot of purchasing power there over the longer term. While in the short term, it can work out in your favor, as this chart here from the JP Morgan Asset Management team showcases. Anything over a 5-year period, statistically speaking, being in stocks and bonds has always been a better place to be.
What's the expression? We can be wrong longer than we can remain solvent. And essentially, what we have to remember is 7 out of 10 years the markets go up. The AI sector, that's why I'm not going to sit there and call a top or a bubble or anything else like that. That's why I specifically say it's expensive. Not it has to come down. It's just I like things when they're a little bit cheaper and the such. Cash right now, essentially over the long haul, if we remain in cash for long periods of time, it will underperform inflation. Even if we're getting decent interest rates from somebody, essentially it should outperform inflation over the longer term, and that means it turns into trash over that long haul. If you're making that prediction that you're gonna catch the falling knife and buy on those lows by having the cash, well, statistically you're going to be right 30% of the time, but you're going to be wrong 70% of the time. So to me, that's if it's a good strategy and sound, that might work, but statistically, I don't like putting that in our clients' portfolios.
Perfect. I think we've got time for one more question here from Sophie Stewart. Everyone seems to believe an AI crash is coming in the next 2 quarters. Also, it seems to me that businesses are already soft in both the UK and US. Does that feel like a recession is on the horizon with the job market softening, I guess, is the question.
Well, I think that's what we were just speaking to is, the economy can be softening, but the stock market doesn't necessarily have to in those ways. AI, it's not the only place in the US economy. It's definitely not the only place in the UK economy. But we're getting better value here in the UK. And as the M&A sector starts to build up, there's probably some great opportunities for some takeovers there that actually helps enhance the stock market in the near term. So that's why we look at some of those lower values.
Perfect. I think we've reached the end of our allotted time here, ladies and gentlemen. So once again, I would like to thank our panelists here for the excellent insights. And thank you to our audience for joining us out of your busy schedules this afternoon. If you do have any questions, please feel free to get in touch with us by dropping us an email on info@dunhillfinancial.com. But otherwise, a recording will be made available afterwards for you to review in your own time. And again, thank you all to our panelists, and thank you to our audience.
Last question for you, Cam. Thanks for hosting. But how many slides in that deck did we not see?
There's actually a few. There's a few that we didn't see, so maybe we'll send that out as a follow-up to our audience.
Do we get the blooper reel afterwards with all of those? Will you
Yes.
email them over to us?
Yes, we'll get the blooper reels of the whole 12 slides that were not covered.
Okay. Thank you, Cam.
Perfect.
Thank you, Alex.
Thanks, everybody.
Thank you, Josh.
See you.
Thanks so much, guys.